Partners' capital and drawings, sharing of profits by partners, interest on capital and drawings, salaries to partners, loan by a partner, fixed and floating capitals of partners. Dear students, today let us learn about capital of partners, drawings of partners, sharing of profits and losses by partners, interest on capital, interest on drawings, partners' salaries, loan by a partner, and fixed and floating capitals of partners. Capitals of partners. There is no implied obligation in law that partners must bring capital in equal or in any stated proportions, and the matter rests absolutely with the partners to decide. It is even not necessary that every partner must contribute something towards the firm's capital, and instances may be found where a partner is admitted into a firm without his introducing anything by way of capital. The capital of a partnership firm as originally determined by agreement may be increased from time to time by further contributions and by undrawn profits, or may be decreased by withdrawals and losses, or the proportions of capital as originally determined may be altered by the mutual consent of all the partners. Such consent need not be expressed in writing but may be tacit and proved from the conduct of the parties. Further, the capital to be contributed by each partner need not necessarily consist of cash payment but may be satisfied by the introduction of assets other than cash such as stock in trade, furniture, plant, etc. by mutual agreement. Drawings of partners. The partnership deed generally includes a clause allowing each partner to withdraw a certain amount at each periodical interval in anticipation of his share of profits. Such withdrawals are debited to a separate drawings account of each partner. Whether such drawings are chargeable with interest is again a matter of agreement between the partners. In many cases, whereas the capitals bear interest, the drawings are not chargeable with such interest. Sharing of profits and losses. The proportions in which profits or losses arising from the business are to be divided will depend upon the agreement between the partners. In the absence of any such agreement, even where the capitals are in unequal amounts, the partners will be deemed by law to be equal sharers in profits or losses, on the ground that the court cannot be expected to enter into questions of partners' merits. It may be that a partner contributing a very small portion towards the firm's capital may bring into the business special skill which cannot be measured in terms of money, and by virtue of this attribute he stands to share as much out of the profits as another partner who has contributed as much larger sum in the shape of capital but who is not possessed of the required skills. Again, one partner may be taking an active part in the conduct of the business and the others may not be. It is evidently therefore left for the partners themselves to decide as to what would be the most equitable mode of sharing profits or losses. Where the partnership deed provides for the profit being shared in a particular manner and there is no mention of how the losses should be borne, the assumption is that these should be borne in the same proportions. Further, it is quite legal and competent for the partners to arrange for the profits to be divided in certain proportions and the losses to be borne in quite other proportions. It is equally competent for the partners to agree to exempt one or more of them from bearing any losses. The share of profit applicable to each partner would be debited to the profit and loss account and credited to his capital account. If there is a loss, the same would be adjusted by debiting each partner's capital account with his respective share and crediting the profit and loss account. Interest on capital. Where the capitals are contributed in certain proportions and the sharing of profits or losses is not in proportion to capitals, interest on the capital of each partner is generally calculated at an agreed rate % and is considered as a charge on the profit and loss account before the ascertainment of new profits. It must be remembered, however, that no such interest on his capital can be claimed by any partner as a matter of right in the absence of an agreement to that effect. Where the capitals are unequal but the profit shared equally, the partner with a large amount of capital would otherwise be at a disadvantage and the one with smaller capital would benefit at the expense of his co-partners. Again, where the capitals are equal but the profits are shared in unequal proportions, the partner taking the largest share of profits would otherwise get an undue benefit over the others, and the adjustment in regard to interest on capital will tend to lessen the inequality. It is thus clear that the allowance of interest to each partner on his respective capital will tend to balance the accounts equitably between the partners inter se, or in any case serve to compensate the partner with a large capital contribution. Interest on capital is debited to profit and loss account and credited to capital account of the partner concerned. Where, however, the capitals are agreed to be fixed, such interest will be credited to the current account of each partner. Interest on drawings. Where the partnership agreement provides for the allowance of interest at a certain rate % on the capitals of the partners, it does not necessarily follow that such interest should be calculated on the drawings. If it is decided that interest should also be charged on the drawings, there should be a distinct mention to that effect in the agreement. Where the capitals and the sharing of profits are equal and the drawings are unequal in sums, interest is usually charged on the drawings arrangement in order that the accounts of the partners may be equitably adjusted inter se. As has been said above, the question of interest on capital and drawings is purely a matter of agreement between the partners, and the partnership accounts will have to be prepared with due regard to the terms and conditions of such an agreement if there exists any. Partners' salaries. It frequently happens that one of the partners may be devoting his entire time to the business, whereas the others may not, and under such a circumstance, it is usual to allow the former an agreed salary before the ascertainment of the net profit. The practice of allowing salary usually obtains in a firm where there are junior partners with hardly any capital contribution who take a very small share of the profits and yet who devote the whole of their time and energy to the business. When such salaries are drawn out in cash from month to month, they should be charged to partners' salaries account. Where, however, lump sums are withdrawn at irregular intervals on account of salaries, these would be debited to drawings account of the partner concerned, and an adjustment would have to be made at the end of each financial period, debiting partner's salaries account and crediting the capital account of the partner with the annual amount of salary due to him. Loan by a partner. Any advances by a partner by way of loan will carry 6% interest by implication unless otherwise agreed upon, and this is irrespective of the fact whether the capitals bear any interest or not, but the partners by mutual consent may agree to allow a higher or lower rate of interest on such loan, in which case such agreement will hold good. A partner can claim a repayment of his loan in the absence of any agreement to the contrary, although he cannot ask for a refund of his capital. In case of dissolution, such loan by a partner would rank to be repaid in priority to the refund of capitals, but after the claims of all outside creditors are satisfied in full. Loan by a partner must be credited to a separate account from his capital account and must be distinctly stated in the balance sheet. Fixed and floating capitals. A separate capital account is opened in the name of each partner and is credited with the amount of capital contributed by him on the formation of the partnership and with further amounts, if any, brought in subsequently as additional capital. There is also a separate drawings account in the name of each partner, and this account is debited with the respective partner's drawings from time to time. At the end of each financial period, the debit balance on the drawings account representing the total withdrawals by each partner is transferred to the debit of the capital account, and the drawings account is thus closed. The adjustments in regard to interest on capital, if any allowed, and the share of profits are credited to the capital account of each partner. On the other hand, adjustments in regard to interest on drawings, if any agreed upon, and the share of losses, if there be any, are made on the debit of each partner's capital account. As a result of these adjustments, the capital account of each partner at the end of the year would be made up of the capital as it stood at the beginning of the year, plus interest and share of profits and less drawings. The capital account is closed by balance at the end of each financial period and will represent the partner's capital at the beginning of the next financial period. The balances on capital account under such a circumstance will naturally fluctuate from year to year, and this is how the partners' accounts are ordinarily dealt with unless there is a definite provision in the partnership agreement that the capital shall be maintained at fixed quantities. Where it is stated that in the partnership deed that the partners' capitals shall be fixed and shall be maintained at the same figures during the partnership, the capital account of each partner would be credited with only the actual contribution to capital. No adjustments will then be made on the capital accounts, and the balance on each such account will remain at the same figure from year to year, representing the original capital contribution. In this case, instead of drawings account, there will be a separate current account of each partner, and the withdrawals by each partner would be charged to this account. The adjustments at the end of each financial year in regard to interest on capital and drawings as may be arranged, and share of profit or loss will all be made on the current accounts of the partners. The current account of each partner will then be closed by balance and will be shown quite distinct from the capital accounts on the balance sheet. A credit balance on such current account left after all the above adjustments would mean that the partner has not withdrawn the whole of the profits and the interest on his capital due to him, and he may draw his balance any time he chooses. A debit balance, on the other hand, would signify that the partner has overdrawn his share of profits and interest to the extent of such balance, and he may be required either to refund this excess withdrawal or make good this debit balance by reducing his future drawings. Where the capitals are agreed to be fixed quantities, the balance on the current account of each partner must be shown as a separate item in the balance sheet. If such an account shows a debit balance, it will fall on the asset side of the balance sheet, and if it shows a credit balance, it will appear as a liability. In the next lecture, we will solve an illustration on calculation of gain with or without interest on capital before adjustment of profits if the capitals are different.